Well, good afternoon, fellow herd watchers and herd leaders. Welcome to the February 16th Valentine / Fat Tuesdays / Year of the Bull, Chinese Year of the Bull session of Bull Sessions. My name is Mark Robertson. I am joined here by Ken Kavula and Kim Butcher. Say hello, guys.
Hello, everybody.
Guys.
Glad to be here.
Yeah, thanks for having me.
It should be a rip-roaring session here. Again, on the heels of Valentine's Day, I hope everybody remembered to do stuff. I bought a couple flowers and tried to behave myself for the session. We did spend the weekend doing a number of things, and we'll show them as we go through the show today. All of the Groundhog portfolios are visible to you, and we'll cover that here in a few minutes. And Kim was the one who made me aware that in the Chinese calendar, it's the year of the ox, I think, technically, but could be considered the bull, right, Kim?
Absolutely. That's how I'm interpreting it.
It is the year of the ox, Mark. I'll verify that.
Okay. And then Kim also sent me that wonderful, egregiously ornate bull.
Oh, we ladies like our bling. Come on.
That's pretty heavy bling.
Well,
Is that supposed to be just an ornament, Kim? Is that all that's supposed to be?
I don't know. I saw it and immediately liked it, and I shared it with Mark because I thought he could use it.
Well, if you run around wearing a couple of those as earrings, Kim, we're going to be worried about you.
No. I'm not that ostentatious. No.
All right. We're going to talk about the lazy long-term posse. That's actually a label put on us by Sean Mace, by the way, Ken. I think we can wear lazy long-term as a badge of honor, frankly. And
absolutely. I'll put glitter on it even and put it right on my lapel, okay?
And the posse part's the part of leaning on friends. So I like the whole thing. So I think I've adopted it, and I'm going to invite everybody to adopt being a member of the lazy long-term posse. We'll get to that when we talk about Mr. Nicholson here in a few minutes.
Mark, I'm going to take my sleep at night investing and just move that button over just a little bit to make room for this other button here, okay?
Good stuff. All right, and we're also going to take a look at and just remind that we are harvesting ideas from this year's Groundhog entries, and we'll talk about that also. All right, let's get the legal beagle boilerplate out of the way. No investment recommendation is intended. This is all about education, and with huge emphasis on the word demonstration. Everything that we do here is based on over 8 decades of experience with the modern investment club movement, as experienced by the National Association of Investors / Better Investing or Manifest Investing. Everybody here is in some way, shape, or form a member of the community. In some cases, we consider our groups to be the one big investment club. And it really is to illustrate the philosophies, methods, and techniques of the modern investment club movement, which can basically be encapsulated as find better companies, buy them when the prices are better too, and rinse and repeat. Keep doing that, and you'll be in pretty good shape over time. Everything that we talk about here are our opinions, our interpretations of the things that we have learned and shared over the years. If we own a company that we're talking about, we'll try to remember to disclose that. And I already mentioned it once, a week from today, on Tuesday evening, a week from today, is our annual awards celebration at the Investing Roundtable. And we just have a lot of fun with that one. We continue to share 3 or 4, maybe 5 ideas with the audience, specific stocks to study. And if you'd like to be added to a reminder list about that, just send an email to nkavula1@comcast.net. If you have any copies or requests for copies of the slides or any follow-up questions, you can send those to Mark R. at manifestinvesting.com, and I'll take care of that. Ken, anything else you'd like to add?
No, I think we're in good shape. We're getting a lot of requests for how do you sign up for the roundtable. So the word's getting out there, and we usually have a really nice audience for our February anniversary program. So join us and help us break a new audience record. That would be something to set our sights on right now.
Well, if the weather keeps cooperating as it has, we might have a shot at that, Ken, because there's
Okay.
nothing on TV and the weather's awful, so could be some good, clean fun. Speaking of the weather,
Punchkis.
a punchki.
Yeah, that's well, sort of a punchki. Yeah.
Well, yeah, I think we took liberties with this one, but today is Fat Tuesday and the beginning of Mardi Gras. And Ken, were punchkis a big part of your childhood in the Cleveland area or not?
Absolutely not. I didn't even hear of such a thing until I moved up into Michigan, Mark. I think they're definitely a Detroit area phenomena because we have a huge Eastern European population where I grew up, and never once did anybody talk about a punchki or a punchki, depending on how you're going to pronounce it.
Well, they're a tradition here in Michigan. In fact, the editor of Better Investing magazine, when I was on the staff there, Don Danko, with huge Polish roots, Don Danko on the morning of Fat Tuesday every year would drive to Hamtramck, which is about 20 miles south of here, and pick up. I think he filled his station wagon full of punchkis and brought him back to the office. So every year we think of Better Investing magazine and Don and Nancy Danko handing these things out and fattening up the entire Better Investing staff on Fat Tuesday every year.
I'll give you an interesting fact, Mark. Did you know that at one time in the 50s and 60s, Hamtramck was the second largest Polish-speaking city in the world, only behind Warsaw, Poland?
I didn't know that, but I believe it. Yeah, there's definitely a huge community down there.
Hamtramck was a little enclave carved out of the middle of Detroit, entirely speaking Polish or its variants, and it was the second largest Polish-speaking city. It was amazing. That's no longer the fact. Most of the children and the grandchildren of those folks have moved into the suburbs in different places, but there's still a heavy influence. Natalie and I still take a pilgrimage down to the Polish market on a once-a-month basis to buy things that I grew up loving as a child and that she grew up loving as a wife for the last 50 years.
All right. Happy Fat Tuesday, everybody. Let's go ahead and move on. Here's a slice of what we're going to be taking a look at today. Again, this is our bullpen of current and future topics, and you can kind of scan that list and see if there's anything there appeals to you. Some of these will be brought to life in the near future. We're going to spend a few minutes with Booyah, Jim Cramer, here for a few minutes. Talk a little bit about the legend who was George Nicholson, the grandfather of the modern investment club movement. There's that lazy long-term posse in there. We are not monkeys. That's a reference to gleaning company discovery out of the Groundhog Challenge entries. And I am just finding a whole bunch of stuff, a bumper crop compared to other years. There's a little bit of fence busting going on maybe compared to other years, Ken, and we'll be dissecting that as we take a look at what's in front of us. But in general, just a whole lot of good, clean fun, and look forward to exploring that. Your thoughts?
I'll tell you, Mark, on February, the first Friday in February, I don't know what date that was. Maybe that was the 5th, maybe.
The 2nd.
Was it the 2nd?
Well,
okay.
You said Friday? You said Friday?
First Friday,
Yeah. February 5th.
5th. Okay, we had a close in our contest, called it a trading day. And in our stock contest in the chapter here, we're allowed to trade. And I shot for the fences by selling EBIX, which had got caught up in that huge short selling concept and had made all kinds of money in the contest in the first 3 months. And I sold it and traded it for Tilray, which was getting all caught up in that phenomenon.
Listen to you.
I'm trying. This is a contest. It's not real money, Mark. Okay. But the only thing I regret. Well, I just regret on the 2nd when I read on the 1st that Tilray was buying another pot company. It was entering into a licensure agreement with somebody in Great Britain. I was ready to put Tilray into my Groundhog thing, and then decided that I would take unbelievable pain from you for the next year. So I left it out. I should have put it in, you know.
Yeah, you should definitely do that.
Yeah.
Well, and again, in the interest of full disclosure, I believe it was me who picked Ebix and put it in the best small companies for this year. So,
Yeah, it's just off on a tear now. Now it's not off on a tear based on anything fundamental. Don't get the idea that we think that the fundamentals deserve some of the valuations that this stock has hit. But we certainly do think that Ebix is a real company with real products and a real future to it. Just not a future that's worth probably what some people have paid for it.
cool stuff. All right, before we get to Jim Cramer, I get 30 seconds to apologize for going crazy last week, but I'm not imagining things. I was disturbed over the huge amount of corrections and drift in analyst forecasts for 2020. And my message this week is based on this picture. We don't show this picture very often. What you're looking at is a picture of the variability, the changing, the volatility in analyst forecasts from the Value Line Standard Edition. And you can see that when things get interesting, back during the Great Recession, again, what was so great about it? It was actually pretty horrible. That was the worst we'd ever seen in terms of this type of volatility. And again, we're talking about the amount of fluctuations in the analyst forecasts. And I just want to point out this little hiccup up there. I'm not imagining things. These things have been all over the charts. So in honor of, we celebrated Valentine's Day on Sunday. It was Abraham Lincoln's birthday on Monday. I think we got to give Honest Abe some credit, and he liked beer.
Now, Mark, that number is coming from the end of the first quarter 2020, right?
Yeah, that's a first quarter 2020 situation. It was the March mania.
Yeah. Okay.
It was ugly stuff.
That's when we were talking about the pendulum swinging way too far in one direction. Okay.
Yeah, and they're coming back. You're going to see over the next 2 weeks, you're going to see everything basically return to normal expectations. It's maddening.
Although, Mark, it looks like the third quarter variability was equivalent to something that was happening back in 2008.
Oh yeah,
that's a pretty high number as well. Second quarter and third quarter.
Yeah, well, the election hadn't happened yet. That's all I'm going to say.
All right.
All right. I heard from a couple of community members on this one. Apparently, Jim Cramer last Wednesday went on a rant, which is even more animated than mine, and probably with the background music from Top Gun, said that the market's in a danger zone, or highway to the danger zone. Great movie, by the way. I may have to go back and watch it now. Tom Cruise and Kelly McGillis. Anyhow, you can read right there just along with me. He thinks the market's frothy, and is just expressing concern over what he is seeing going on in the stock market. Now, Ken, I know you're a junkie that you watch CNBC every night. Did you catch this episode?
I don't watch it very much in the evening, Mark. It serves as a background to my work when I sit down for 2 or 3 hours and work at the computer. But I do not usually watch Cramer around dinner time or after dinner. So no, I did not see this. It's interesting, that third point that he's making, because we've been discussing this off and on as a couple. And we've been discussing this off and on in some of the clubs that I belong to, that do you start to believe some of these sells that are coming on stock selection guides? I had gone for years, for 3 or 4 or 5 years, without ever seeing a sell on a stock selection guide. And recently, last 6 months, 9 months, 12 months, I've been seeing sells on not just one guide, but on 3 or 4 or 5 in a typical portfolio. And my portfolios are anywhere from a dozen to maybe 15 stocks. And this idea, do you take some of that money and just let it rest, or work very carefully to find stocks that you think are going to move the other direction and do it in a better fashion than the ones that are overvalued? And that's quite difficult at this time, by the way. That discussion's been going on in my life, but with everybody that I'm partnering with to invest.
Mm-hmm.
So we're on the same page. We're coming down regretfully and selling pieces or all of stocks that we've held in some cases for 10, 12, 15, 20 years. And right now, at least, I'm trying to stay disciplined and do most of that in my tax sheltered accounts. But I'm also not afraid to take some capital gains, thinking that perhaps the low point on capital gains tax has been reached. And I'm not predicting we're going to have higher capital gains taxes for moderately incomed people. But I do think we've reached the lowest they're going to possibly be in the next 8 or 10 years. So why not capture some of them, as you're going forward?
I would agree with that too. And in fact, I was drawn to that third point. And I think in terms of dealing with people who are more senior or more in capital preservation mode, that type of stuff, I can't see anything wrong with scouring a portfolio, seeking out the lower financial strength companies, or perhaps one you may have speculated on. In fact, I'll give a hat tip to Jim Cramer, because we spent a lot of time on this in the middle of the summer. He had put out his COVID portfolio, which many of you in the audience will remember well. There were stocks in that portfolio, if you decided to pursue those, some of them more speculative opportunities, I would see absolutely nothing wrong with, trimming a few of those and celebrating some fantastic wins.
I always call that peeling off a few layers of the onion.
Yeah, and there's nothing wrong with doing that. I don't think you need to panic, and peeling the onion can be a good exercise too. I don't think you have to get carried away, and I'll show you why I believe that here. First of all, the concern is genuine. If you want to talk about froth, this is what we were talking about last week. Ken often points to this. You can throw everything else out the window. That green bar is well above the long-term blue trend line, and that's the representation of the stocks in the value line standard edition. And by the green bar, it's a price bar. I can't find a point at any point on that curve, Ken, where it's been any higher. So, I mean, a little bit of trepidation is probably healthy.
Absolutely. And even if you consider the length of the price bar above the blue line as a percentage of the length of the price bar below the blue line, which probably would be a fair way to consider these, I still don't think that you're going to be at any place in the last 7 or 8 years where the average where the actual value has outstripped the trend as much as it's doing right now. At the same point, I'm urging everybody that if you're going to generate a lot of cash, you might find better places to park your cash than just in a dollar amount sitting in the brokerage. I do think there are places where you can hide that might guarantee you a little bit better return than what the typical brokerage house is willing to pay you. And I think you should spend a little bit of time seeking that out, reading the things that we're going to look at today that George Nicholson put together in the late 30s and into the 40s. He was never afraid of seeking some investments that were very non-traditional and yielded very small percentages compared to what some of his stock portfolios were yielding, but it was a good place to put cash. And I think that's not wrong, especially when you're designing a personal portfolio.
Absolutely. So one last hit on the Kramer moment. A couple busy slides here. Let's start with the one at the bottom. That is simply the median projected annual return. That's the median return forecast for companies in the manifest investing universe. And I will point out that it's down at levels that we haven't seen in a while. I mean, the median or middle stock in the portfolio has been hovering around 5%. And that simply means that, the average stock, across the whole sample, the universe of companies that we cover, their stock prices have been rising faster than their fundamentals would typically suggest. Basically outstripping or outrunning their fundamentals. And all that means.
Mark,
Go ahead.
Mark and Kim, have your portfolios, has the par in your portfolios outstripped the my par number in the last 4 or 5 months? I was having trouble coming up with a portfolio that was trying to stay 4, 5, 6 points above my par. And suddenly most of my portfolios are staying 4, 5, 6 points above my par now, where for a long period of time, maybe for as much as a year, felt I was always running and was never keeping my par more than 1 or 2 or 3% above my pars. Have either one of you experienced that same thing?
Go ahead, Kim, and then I'll chime in.
Well, my thing is I do like the spin-offs, and it takes a while for that to get recognized in the par. So I can't always go by par when I put my things in a dashboard. I kind of put my own par in there. Does that make sense?
Absolutely.
It does make sense. She's a bigger fan of general market securities and some of that non-core stuff than we are sometimes, and there's nothing wrong with that.
Yep.
I will say, Ken, that we witnessed that firsthand with the roundtable portfolio, the 10-cup model portfolio, and exactly what you described. And I think what we saw happening over the last quarter, and I think it will persist, is that the forecasts on those companies that which we see as high quality are actually going to behave themselves and justify the higher prices. And it all shakes out in the forecasts. So again, our point here is that the par is down at levels that we haven't seen in a while, and it's not dramatically low. And with that, I'll switch to the chart up at the top. This is if you want more on this, actually go to Manifest Investing and do the search at the top of the page on that ticker symbol, which is USHL. What you're looking at is the net of new companies making new highs versus new lows. That's the squiggly stuff up at the top. In the background, that's the S&P 500 behind the chart. But this is just based on the reality, going back as far as we can measure, that the wheels start coming off of companies before the stock market corrects most times historically. Again, the sample size really is weak. That's true with 99% of the things in the realm of investing. But what happens is you start seeing more and more lows versus highs, and there's a deterioration, the type of deterioration that we saw back in 2008, and then a couple times along the way. December 2018, it was actually fairly significant, and we had a moment. And then the moment that was the ugliness of the last year, notice that the number here is actually lower than back here. Again, I think that's the rhinos and the analysts really kind of messing things up. I pay attention to that blue line. If that blue line isn't breaking down, I mean, even for somebody that's fairly well along in the experience category or protecting assets, whatever, I don't become concerned. I probably did become a little bit concerned back in this time frame, but it passed. And what I would point to right now, if I'm thinking about investing real money right now, I really do not have a lot of reservations. The only caveat I would place on that, and that's based on this stuff down here, is I would probably be buying the deepest of the deep blue chips. I'm actually kind of attracted to companies like Johnson & Johnson right now because it has a boring 9% return forecast, and I'm willing to be bored all day at 9% when the market average is 4%. So just
Sleeping at night is really good, you know?
getting bored by those.
Oh, no, I'm just saying I really enjoy sleeping at night because, you know, sometimes we get busy in life. We don't even know what's going on in the portfolio. And you've got those good companies that you can sleep at night with. You don't have to look at. You're like, oh, okay, whatever.
Absolutely.
Mark, help the audience out. Everybody's guessing that on the legend up in the left over there, that the MA in the EMA stands for moving average. What's the E stand for?
EMA stands for, I believe, exponential moving average.
Okay.
So it's just a mathematical smoothing.
Okay.
You want to think of it that way? All right. All right, let's spend just a few moments before we break into the Modern Investment Club movement and George Nicholson. Just a reminder, our champions for last year were Andrew Spector of New York and the Orange County Model Club. The whole article will be up probably later today at Manifest Investing, and you can see Sandy Castor's smiling face because she took over the all-time lead. And again, thanks for everybody, and everybody good luck for the coming year. Just as a quick reminder, we did have a good year collectively, which is really kind of a moment of relief for me for the last year. 2020 was kind of I think we called it a year that we look forward to forgetting in many circles. When it came to some of the investments made in the stock market, we were just talking about Kramer's COVID list. Some people did fairly well, and I think basically all of our family portfolios did pretty well last year, and that's kind of a moment of relief. Any thoughts on that, Ken?
Well, I can't. I don't think, Mark, that if you would have told me when I was 60 that I'd have the size portfolios that I have today, and that they'd be increasing in any year. Like they increased in the last year, I would have said that you were on something. Maybe dealing with one of the stocks that I just bought right now, that Tilray stock. But it was an absolutely fantastic year last year, which doesn't make me feel good about taking profit, but it begins to explain why taking profit sometimes isn't all that bad.
Oh, absolutely. Especially when there's Johnson & Johnson's and Intel's to be had also under the right conditions, of course.
Well, I will just say, Mark, that I've held Johnson & Johnson for almost 40 years now, through thick and thin, through up and down, that one, and I'll add Procter & Gamble and Microsoft to them both. My father-in-law bought 3 shares of Microsoft back in the mid-'80s, and the one share that came down to my wife has since blossomed into many other shares. We've bought more, and it's split a number of times. But those 3 stocks, you can't do any better with sleep at night stocks like that, especially when you're my age.
All right, you're making me all warm and fuzzy. All right. Speaking of warm and fuzzy, let's talk a little bit about the selections for this year, and I want everybody to be aware that where they can do some mining, good, clean fun. All of the dashboards have been entered, and all of the results are in. This is from our Y charts fueled database, which keeps everything very current, as in to the minute. In fact, Marie Frank in the middle of the day is number 1 right now, with a return of 25%, not 20, up at the top of the chart. And it's kind of interesting to see the percolating around. Blemcool has moved up to 28% or 28th in the middle of the day. So you can just kind of go down that list. A lot of fun names. The ones that are most notable by their absence would be the Roundtable Knights, and we've sent out a search party for Ken and Mark.
There's a round table gal in there, though.
But we do have a damsel on the leaderboard, and Herb Lemcool's a guest night, so at least we do have roundtable representation in the top 40. So good, clean fun. I do find it fascinating that it's just wild to look at this list and see 76% of the entrants beating the market. Even though I know this is just 2 weeks, and Mark, calm down. We're just 2 weeks into a 1 year thing. I get it, but it's still fun.
Well, yeah, I think we have to count Ken in there because his family portfolio, the Kavula family from Michigan, is in that top 40.
But Kim, I don't know if you're aware of this. That's not a club. It's more a conspiracy.
Well, there's always those every time, Mark. You run the dashboard. Sometimes we wonder if there is a conspiracy there.
Oh, can I block her, Ken?
I don't know, but
I don't know.
she's just getting back on you for where she finished last year. That's all.
Oh, no, she wants to block him.
Bing, bing.
It's the long term that matters. We're going to be talking about that, remember? All right. So you guys can all scan that later on. As I said, Maria's taken the lead, and I just want to make a point that you're going to see happen. This is Marie's 6 selections for 2021, and 3 of them are in our coverage universe now. These 3 companies are not. And I'm adding them to coverage. In fact, a couple of them were added this morning to coverage. So we'll pull up that and show you that those are going to fill in automatically, and the dashboards will be kept current. They will resemble these numbers within a few days. Okay. People have asked, well, what are these zeros? Am I going to be stuck in cash? No, they'll catch up. Just be patient and wait for the analysis work to be done.
I always worry that when you race to the front, as soon as the dashboard starts, you could end up at the end a year by the time it gets to be a year later. I'd rather gradually crawl up the ladder.
We have seen that, but we've also seen people that are near the top of the leaderboard at the end of the first quarter actually stick around. So we'll see.
And Mark, you are being reminded by some of our audience that this is a marathon, not a sprint. Okay.
Our audience is right. All right. So one of the things I wanted to make everybody aware, because I think most of you are, but I just want to be sure, as we go through and actually add companies to coverage, on our weekly updates, this is always a section in the ones where we actually do some additions during the week. You can see right here that these are the ones that have been added. This one includes a link to Issuer Direct Corporation. I'd never heard of this company. Added by Marie Frank's Groundhog dashboard. And here's what it looks like. I find it compelling. Ken asked me about the company a few days ago, and I said I would put this in the category of a early stage neogen, by its appearance. They're certainly not in the same type of industry, but in terms of just the visual analysis of the business model, and they appear to be doing a few things right. This is obviously a very young company with under $20 million in sales. And then we also talked a little bit offline about how Chuck Allman, we've mentioned that, and I think we'll probably spend some time talking about the subject here within the next month. Chuck Allman used to write the Growth Stock Investor newsletter, the highest ranked newsletter by Mark Hulbert for the better part of 30 years. And he always had this small company in there called Mocon, M-O-C-O-N. And it would have been a company in this same type of very small category. And that thing just generated extreme outperformance for him over the years. So it can make a lot of sense. So watch for the companies to be added and look for companies like this. This is kind of what we were talking about, Ken.
Absolutely. I really like these charts when you put them up, Mark. I know that they take a little bit of work on your part, but I think they give people a really good picture of what the potential might be going forward, and it's nice and compact and easy to understand. I spent the morning looking for an industry to study for one of my investment clubs, and I came up with 4 tickers that I will give you after we're off today to maybe add to the database as well.
Okay, that sounds good. So again, you can go and watch for additions. I'll be adding a few more companies to kind of round out the ones that need coverage in the rest of the Groundhog portfolios, and should be done with that in the next week or two. All right. A week from today, we do have our Tuesday evening session of the roundtable where we hand out the Golden Knights. And Kim, you are invited back this year.
Oh, thank you for the consideration.
Hopefully you won't hog all the statues again this year.
I believe in sharing.
Sharing is a good thing. And just to show you that, the crowds are already forming and they're in line to get their tickets there. Sleeping.
I hope you're in Florida in a line to get tickets, not in Michigan.
Mark, we're getting a question from Dwight, and Dwight says, is the data that you're using to form these pictures on the last slide, is it coming from a Morningstar data feed like you use in Toolkit, or is it coming from Value Line? And I think I know the answer, but I'll leave it to you to answer.
Yes. Just kidding. It is from Y-Charts. It is some of the data that they source is from Morningstar. I did not try to run an SSG on the Better Investing website, so maybe that's something somebody can do as a homework assignment afterwards. This data is coming from Y-Charts, and some of it is sourced from Morningstar. Okay?
It's great. Let's keep moving. Yep.
All right. So let's go ahead and talk a little bit about the heritage of the modern investment club movement. And Ken wanted to spend some time just talking about some of the legacy literature, I guess would be the way to put, and legends. So I'll let you spend some time with us, Ken.
Well, Mark put some notations on his front page of his website about some different articles that he was going to take a look at and wanted us to maybe read and discuss. I would suggest that I'll give you a couple of just highlights from a couple of the articles, and then maybe next week we'll discuss any questions you might have about these articles, or we'll take a look at them in a little bit more detail. But they're fascinating, absolutely fascinating. One of the articles basically is being printed by Harvard. Nicholson has an MBA from Harvard, had an MBA from Harvard. He was there in the mid to late 30s, earning that MBA, and this is from a publication called The Alumni, and it's a pretty extensive article that kind of sets out how Nicholson envisioned an investment club to work. It shows some early portfolios that belong to the Mutual Club of Detroit. And it's fascinating to look at these portfolios because, frankly, there's not more than 3 or 4 company names that I even recognize coming from the one report is from 1952, so it's 70 years old almost. But it's very difficult to recognize any of the companies. They've gone through so many different name changes and mergers and disruptions. But it's obvious that the original philosophy for putting together an investment club portfolio was very close to what we've been talking about in the last couple of years, which was to keep a good 2/3 or more of your portfolio in these outstanding high quality growth stocks, the up, straight, and parallels of the world, but to take a little bit of your cash, especially as you gained experience and gained a little bit of cash to play with, to take some of the cash and to put it into non-traditional investments. He certainly has a number of very non-traditional things in this 1952 portfolio. It's also interesting to see the valuation, how much the portfolio was worth as you go through a series of years leading up to 1952. I think Mark has that picture. There it is right there. Very, very interesting to see the liquidating value versus the deposit value. and see it rising from basically 1-to-1, which you would expect at the end of the first year that this club was together, but moving up to about a 3-to-1 ratio within 10 or 11 years. Very, very dramatic evidence, if you will, of the increase from what you put in to what you can conceivably pull out if the power of compounding, the power of groups having their money put together and dealing with it, and maybe just the power of having a lot of people contributing to ideas in the first place. The article is very thorough. I find it fascinating to look for things in both articles that I know Nicholson changed his view on or polished up his view. At one point in one of the articles, he talks about not looking at any stock that doesn't have at least a 10% sales growth. Remember, that would preclude a lot of the blue chips that we tend to look at today as a part of our portfolio. And he, at another point in these articles, he talks about not looking at a stock that has a 15% movement up, but the potential to double. I know that in his later writings, Nicholson became a very firm proponent of portfolio-centered management for his stock portfolios and for club portfolios. And he began talking about a 15% return for the entire portfolio, not for each stock. And at some point, he got to the place where he either recognized himself or he was convinced that there was a place for some of these very high quality blue chips in a portfolio, even though they might only grow at 5 or 6 or 7%. They might have enough dividend to balance out that slower growth. Go on, Mark.
Ken, hearing you say that, I got to go back and read it for the 4th time now. And by the way, I thought I had done it, but I will put this Harvard Alumni Review article. It's basically about the evolution of investment clubs. I'll put it in the session notes, and we will be looking at it in a little bit greater detail. But back to what I was thinking, he talked so much about being a source of venture capital and stuff like that. I have this feeling that, especially in the early days of the club, they spent a lot more time on smaller, startup companies. Now, they wanted a track record when they did it, but and that's probably part of the reason that we don't recognize many of the names on that list you were just talking about, Ken, because I think they did have an emphasis on these smaller companies, and I think that kind of got evolved / diluted in the 1990s and time frame for the modern investment club movement. And it'll be interesting to take a look at that, because I agree with you. I think he transitioned into a core up straight and parallel defensive mode, basically dominating the portfolios after they'd been doing this for a while.
Yeah, I was going to add, Mark, that I agree with you with this idea that they were looking at very small companies because they were talking about maybe being able to purchase a company. In fact, that was the original impetus for the formation of the club to begin with, that the gentlemen were having a hard time finding jobs at this time, and this precludes the war. But they were having jobs before the war began, and they thought that maybe they could actually start their own business and hire each of them to do various jobs within that company. That evolved into looking at small companies and maybe being a source of venture capital. I think that what might have happened also is, as the movement grew, and as clubs began springing up in places where there were not a lot of local small businesses, that they had to slightly alter the philosophy of what you were looking for to kind of tailor it to places where, if you're sitting at that time in the 20s or 30s in Grand Rapids, you're not exactly a hotbed of population growth or of business growth at that particular time. Now, Grand Rapids is a very dynamic community today, and there's all kinds of business opportunities, but back in the late 30s, it was pretty rural, as was most of the state of Michigan, except for the city of Detroit and the surrounding close-in suburbs. So I think just finding his evolution of thought and then trying to imagine how his thought would have evolved from the last time we really read his writings in the mid to late 80s until today. I mean, come on, let's face it. That's we're looking at 35 years now since that point, and we're looking at huge technological changes. I think that indicates that there would have been similar evolution of thought and similar changes to how you put together a portfolio as different tools became available and as different resources became available. I can remember back to the 90s bemoaning the lack of resources to help me even study the simplest company and seizing on almost anything that I could read about a company, you know, finding it very difficult to come up with a lot of information. When I first discovered company websites and discovered that they were putting up presentations that gave us an idea about how they were going to grow, that was just a mind-opening experience, that here I could get some ideas right from the company's mouth about where they expected to be, not necessarily with earnings or with sales, but where they expected to be with their business model in the next 3 to 5 to 7 years. So I'm sure that Nicholson would have grown with technology, would have grown with the times, and I don't think you ever would have found him standing in the middle of an office confusing a copy machine for a computer or for a fax machine.
Well,
so you know.
Yeah, the other thing that comes to mind as I scoured over this stuff, preparing
Private joke, folks. That's why Mark's chuckling. Private joke. Okay.
The thing that struck me, though, again, is that lesson which we have, I think you and I have learned. I hope others have at least tackled it also, is this notion of you can have a small company, a Neogen out of, East Lansing, Michigan, comes to mind, that is extremely well managed from the time it's embryonic. And I really think he spent a lot of time on that. And I don't think I understood that quite as well 20 years ago, but this notion of demanding all of the core quality concepts from these companies, no matter how embryonic they are. And there's a couple other quotes in here, but I thought we might just close with this one, Ken. Maybe just spend a moment. I'm pretty sure these are straight, his words. And how did he conduct his company studies? And you can, maybe close your eyes and go back to think of 1950 or 1960. And it's right there in writing. He read everything he could get his hands on. You just heard Ken talking about company websites. He would have looked at company websites if they had existed then. So, I mean, he looked at all the major sources. And look at point number 2.
Well, what's so important to me, Mark, is that he focused on the first 2 sections, on the quality sections of the stock selection guide, 2A and 2B. He extended the ideas from section 2B to help him measure management. And then he did something that I think most people aren't even aware you can do with an SSG today. There's actually more pages to an SSG than just the original front and back of the first page. There's a report that went with it originally where the SSG prompts you to try to answer questions about your company. And the questions are deliberately there as a prod to make you think, and to make you think as the managers might think. Questions like, what exactly will drive the growth? Not just, I think it will grow to at 15% for the next 5 years, but can you name specifics that are going to drive that growth? What might hinder the growth going forward? A lot less reliance on PE values and on zoning than you might expect, and a lot more reliance on the thought process. Perhaps when our original teachings came out in the 90s for us to spread around the country, we captured the idea that the SSG was a guide to your judgment, not necessarily a black box of any kind, but we made it appear to be a little black box-ish by focusing so much time on sections 3, 4, 5, which is heavy with arithmetic and kind of light on thinking a lot of times.
Well, I would agree with that. In fact, I remember vividly, you talk about actually thinking through, how is this going to unfold? And a thing he had written about Toys R Us and the notion of geographic saturation, where at some point you've got more Toys R Us stores, outlets, and you can't basically add any more and do it to the same level of profitability. And boy, did that ever turn out to be the case. Thinking about geographic saturation as a topic during a study. And I think there's just some powerful reminders here. Now, that's why I like your suggestion, Ken, of let's take those other two articles and dig into some of the harder core fundamentals, foundations, if you will, and go forward. I also my thoughts drifted to Elon Musk here. And you want to talk about dreams. What would Nicholson have thought about Tesla? It's an interesting question. I don't know.
Well, one of the things I always think is really good to do is when you go to the 14A filing, which many are not aware that it's called that, but that's the proxy. And in the proxy, it has management's compensation, and it is a very big eye-opening experience to find out what are the metrics that your management team of the company you're considering buying or you have in your portfolio, what are the metrics for them to get their bonuses? And is it a bunch of financial jargon that means nothing, or do they have actual jargon in there that says sales must increase by XYZ, new clients need to be increased by XYZ, each division of the company must grow by XYZ. When you find out what the metrics are so the management can get their bonuses, you find out what their motivation is. And do they have motivation or not? Is there nothing in the 14A that makes them have to be able to get their bonuses, period? It's just nothing.
Yeah,
And
just
Kim,
to say that, I'm reminded of Joshua Brown, the reform broker, and he does a wonderful presentation on understanding incentives. And if you can actually track the incentives, you can probably figure out, which way the wind is blowing with lots of different situations, including company analysis. So good thoughts.
Well, and also, Kim, when you read these incentives, and if you read, sometimes you find incentives that you say to yourself, this sounds absolutely counterproductive to what a good company should be doing. For example, an incentive that says we will give our CEO a bonus if they slow the rate of decline of loss of business. Think about what I just said, and think about why in the world would anybody be in line for a bonus on a goal such as that? You can many times just use good common thinking to ask yourself, is this really incentivizing somebody, or is this what's going to happen and they're just getting a bonus as a matter of course?
Well, that, and I think the other thing is, I'm one of those believers that cash pays the bill. So I like to know what the cash flow of the company is, and I may not always be as leaning on their EPS. But the thing is in looking at the cash, how good, and this is paramount, how good is the management of that company good at capital allocation? If they're doing nothing but acquiring a stock, but they can integrate it and they can keep their goodwill effective at a decent rate, that means that they can grow the company very well because they've got great capital allocation skills. But if they keep buying stocks, other companies, acquiring them, and they're paying too much for them, ultimately what's going to happen is you're going to have to they're going to have to write it down because they paid too much, and then you're going to end up with another issue. And then because you've had the write down on goodwill, I mean, that even happened with Kraft Heinz, the stock price drops. You need to be aware of these things.
Yeah, in fact, Kim, I think that's a perfect segue to what Ken and I had talked about, taking some of the specific excerpts from that Harvard report. In fact, one of them, in our opinion, is a path straight to that projected return on value, which includes capital allocation. Fair to say, Ken?
I think it's very fair to say we'll let people read through it and see if they can pick it out. I think, Mark, also the final line in the first paragraph in number 4 deserves mention before we leave the topic also, and that's not only to look at your company in isolation and do all this research in isolation, but it's to bring in ideas from the competitors and at least get a rough idea of how the competitors are working and how they compare the company that you're studying to the rest of the companies in the industry. I think that's extremely important in the long run, or I think a lot of times you end up with companies that aren't sitting at the top of their industry and therefore aren't giving you all that industry has to offer.
Absolutely. The reason
well, that and even Matt Spielman's got a comment here in regards to capital allocation that he really admired Panera because they actually, in their quarterly and annual reports, they said they had significant share buybacks approved, but many quarters bought nothing. Why? Because they considered those buybacks versus other capital investments and only did so, only if they could meet the common 15% return goal. Those great companies, in their quarterlies as well as their annual, you need to search for the terms capital allocation. It's a great way to find out, are they walking the walk, and are they whatever they're saying, are they following it, or is it just, BS?
Good stuff.
Mark, I'm going to unmute Sean Mace, and Sean has a comment. Go on, Sean. Sean, you're self-muted. There you go.
Yes. Actually, what you are hitting on is perfectly, is just a crazy. Elon Musk, actually, as far as a real-world example right now, if he maintained an over the course of 6 months, $100 billion valuation over the course of 6 months, Elon Musk would be heavily compensated in some $700 million in stock options for Tesla. It was a large amount of stuff. So you can really see their push to, or their drive to get where they want their company to be, just all in it for themselves.
Well, I've mentioned this before, and one of the stocks that they is part of that PayPal mafia. When you the new stock that came out, Affirm, AFRM.
Yes.
CEO Max. When you look at the filings, his salary is $10,000. Now, why is that important? Well, obviously, he's not expecting a big payout from that. He's expecting on how well the stock is going to grow. So he's making sure that he's not getting paid big bucks. So unless the stock price goes up, he's not going to make money. So what does that tell you?
That he better be lucky or good.
I think good if he was part of PayPal already.
All right. Good stuff. All right, I think that's a good segue. We are at almost an hour. In fact, we had Sean here. Sean, I think, was the one who came up with that long-term posse investing, and that's obviously a screenshot from Blazing Saddles, and
Quite a movie to choose, Mark.
good, clean fun. All right, just a quick reminder, a week from today. It's a black tie event, jammies, optional, bring your own beverages. All right, I'm going to go ahead and just close down with a reminder that we do archive these sessions at YouTube so you can grab them and listen to them at your convenience. If you're unable to attend in person, that does include all the roundtables also. We have been talking about books. We're not going to do that today because we're basically out of time, although I think we're going to discover a few along the way. I will just make the point that PayPal, she calls them the mafia. There's big write-ups about all of the PayPal entrepreneurs in that 0 to 1 book.
Well, the other thing is that Mark, you and I need to get into, I think it's called the Renaissance Fund, and it's all the stocks or individual investments that Peter Thiel and that mafia, the PayPal mafia group, have put their money into.
Mm-hmm.
And then it's interesting to see when they start maybe spinning out.
Absolutely. And before Kim gives me any more homework, we're going to move on to just closing things down. Any final thoughts, Ken?
No, we have a few questions that we can maybe talk a little bit about after the session. I'm going to give you 4 tickers after the session to maybe add eventually to the database, and we'll see where we go. We don't have a lot of questions left over today, Mark.
Okay, yeah, I think we generated a considerable amount of head scratching also. And plus, I think I encourage people to be diving into those portfolios and looking at some of those yet undiscovered companies. But in that spirit, happy Valentine's Day, happy President's Day, happy Year of the Bull. And thanks for attending today's session. We'll be back in a week with a few closing comments on some of the discoveries in the Groundhog Challenge and a continuation of lessons from the Modern Investment Club movement. And I think Ken and I will be able to jam some fairly interesting stuff out based on
Yeah, and if you get a chance, folks, to read any of those articles that Mark has featured on his homepage, especially the ones about Nicholson, take a moment to read through them. They're not that extensive, and they're an easy read. Whoever wrote each one did a real nice job. So take a moment to read it and think about a few of the ideas that are being proposed.
So with that, we'll just sign off and say, see you in a week. Thanks, everybody.
Bye-bye, everybody.